Ravi Vishwanath, he's the CFO rather, joining in from Teamlease to talk a little bit about their, about the salary hikes that have taken place, their overall, the job scenario, the revenue growth targets, are they achievable or not, and what the trends are when it comes to the job market. Well, good to have you on board. Many thanks for joining in. To begin with, let's just first talk about, Mr. Vishwanath, the Jobs and Salaries Primer 2019. That's a report that has been published by you. What are some of the key takeaways? Because we've been talking about a slowdown. We've been talking about the overall unemployment status as well. What is the current status when it comes to jobs?
Thanks and good morning. There are pockets where we see hiring happening today. The banking and financial services sector, the digital e-commerce sector, and there are quite a few other companies that actually have been hiring, notwithstanding whatever we are hearing from all the others about job losses, etc. If you were to take our own case, we've had a very good Q1, probably the best Q1 for the past so many years. And it's important for a company like us to add numbers in Q1 which will actually get the momentum for us for the year and actually take us through the rest of the year. If I can just step back and just walk you through what have we told in kind of investors, analysts and the street. We had said that we will be a consistently warm company. We will target a growth of anywhere between 20 and 25% year on year, and that we believe we should be able to achieve no matter what the market conditions are. So I think the same is applicable for us even for the current year. We should be able to get to anywhere between 20 and 25% kind of revenue growth for this year, notwithstanding whatever people might say, jobs, no jobs. I think we seem to be pretty okay on that front.
Okay, now if we look at your Q1 numbers, your revenue was up 23%, driven largely by general staffing, while specialized staffing grew a little slower at 10%, and HR services fell about 26% because of a delay in collections from the government. Talk to us about some of these trends in the near term, how things are expected to shape up.
Yeah, general staffing would continue to be the same. I think the same kind of growth can be expected in the general staffing business. IT, again, for us, IT would probably be anywhere between about 25 to 30% growth year on year is what we believe is a reasonable expectation of us. And other HR services would be seasonal for us because it all depends on our ability to bill and collect monies from the government, which is our largest customer. So that incidentally is also a very small percentage of our total revenues. For the whole year, we might probably do about 130 crores, 120 to 130 crores in other HR services, compared to about 4,000 plus crores in the overall between general staffing and specialized staffing services.
Okay, fair enough. That's the growth within your individual segments. Now, can you just tell us what efforts you're undertaking in order to turn around your loss-making entities, and what are the plans for more markups on your value-added services?
Okay, some of the acquisitions that we did are not expected to break even for some more time. We acquired a company called School Guru, which is the largest online education company in India. They work with about 25 universities and have about 150,000 students on their platform. They would be breaking even by about Q2, by Q3 for certain, and stay positive thereafter, and they will be positive for the year. If you take Avantis, which is the cloud-based SaaS compliance platform, the first of its kind in the country, that is also expected to break even by Q4. They will not be profitable for the full year, but Q4 they will be profitable and will continue to stay profitable thereafter. Freshers World was the other entity that we had acquired. We did incur some marginal losses on account of new product development that have actually been launched at Freshers World, they will, and there is some amount of marketing spends that we will incur, not a great deal of money. So Freshers World will again was a profitable company because of the product development that we've actually incurred some incremental costs, but they will also break even by about the fourth quarter, and thereafter for next year they will continue to be profitable. Overall, I think all the other businesses for us will start, we will get to different levels of profitability. The permanent recruitment business will turn profitable between Q3 and Q4 and be profitable for the whole year. Same with the training services, and the compliance business, which is the one business which for us will actually turn profitable in Q4, will not be profitable for the whole year, but will stay profitable thereafter actually. I mean, there have been too many businesses, but I suppose I've actually made it quite clear in terms of how they kind of pan out.
Primer also says that increments are going to be moderate across key sectors. So which areas are going to be top paymasters, underpinning double-digit median salary hike, and which ones do you think are going to be at the bottom?
The increments will probably see sectors that are hiring are where you will probably see increments actually, because that's purely a demand supply situation, and we believe at this point in time it's going to be digital, e-commerce, logistics. They are the ones who are going to be hiring. Your financial services and fintech companies are hiring, so that's where we can probably expect even high single digits and double digit kind of increases. Obviously, the manufacturing sector is in some amount of stress. Our own exposure to the manufacturing sector is quite low. But having said that, manufacturing is where you will probably see some amount of lower levels of inflation actually. Of salary hikes, lower percentage of salary hikes.
Analysts are penciling in close to a 20% revenue growth from the company this fiscal, with a similar increase in your bottom line. What are you aiming for, and can you tell us a little bit about your inorganic growth opportunities as well?
I think analysts' expectations of 20% growth is reasonable. Historically, if you were to look at it, while our top line has grown between 20 and 25%, the bottom line has actually been higher than that 20. It's been higher. It's been at about 30+%. We expect the same trend to continue in the current year as well, with the bottom line growing faster than my top line. So that trend I think will continue for sure. There are, on the acquisition front, there are deals in the pipeline that we are talking to. There are different stages at this point in time. I would not want to talk much about it, but there are multiple deals that are in active discussion with us. At what stage they will fructify, at what stage they will close, is actually anybody's guess. Some are closer to the deal being announced, some are a little away actually at this point in time.
We certainly look forward to those announcements on that front, but I just want to talk a little bit about the job trends and the growth, etc. Do you think that we can see some sort of a clarification from the HRD ministry on the PF notice issue that has partly affected trainee growth?
Yes, we do believe that the trainee growth has been impacted with some of these notices that have been issued. It's more from the Labour Ministry that these clarifications ought to be done. And probably it's also because certain people have not been, certain unscrupulous people have actually not done the right things which has led to this, and I wouldn't really blame the authorities for something like this. But having said that, a clarification issued by the HRD Ministry on NEEM notification or by the Labour Ministry on the PF would actually go a long way in helping us get back to the growth that we've seen in the past on the NETAP trainees actually. The NETAP trainee is a very important piece in the overall labour people supply chain of people getting trained on the job, and I would not want to see anything which is hampering that part, which is actually going to improve people productivity in the longer term.
Can you give us some clarity when it comes to your margins as well? Because you do have the adoption of Ind AS from Q2 onwards. Will your margins sustain at levels of about 2.5%?
Ind AS for us was actually applicable from Q1 itself, actually. So we have done the transition to Ind AS, so especially the lease accounting part. We have some marginal impact of the Ind AS on our financials for Q1, and that will continue for the rest of the year. We do believe, like we've said, we were at 0.9% when we did the IPO 3 years ago, and our stated objective at that point of time was to take the margins to 3.5%, which is where the global staffing companies operate at. I think we are on track to take it to the 3.5%. We are doing everything possible under our control, be it on the people side or on the technology side or on the business side. We are doing everything that's under our control to take it up. We have moved from 0.9 to about 2.1, 2.2%. I think the trajectory to take it to 3.5 is quite clear, at least in our heads, as we actually close quarter after quarter.
Joining us and talking us through those trends on the jobs front. Thanks so much.